Hello, in this lecture we're going to work some test type questions, shorter questions that could fit on a multiple choice type question. We have here a company issued 10% 20-year bonds with a par value of $790,000 that pay interest semi-annually. The current market rate is 9%. The amount of interest owed to the bondholder for each semi-annual payment is what? So it's going to be a typical kind of bond that often happens in these types of problems. And what we need to know is which rate are we going to use? Are we going to use this rate, the rate on the bond? Or are we going to use this rate, the market rate? And of course, when we're trying to calculate the actual interest that will be paid, we are actually going to be using the rate on the bond. That's what will actually be paid. And typically, a lot of the times, it'll be semi-annual, meaning we're going to have to take the interest rate for half the year. So the interest will be paid on these bonds every 6 months, half a year. So $790,000. What rate are we going to use? We're going to use the rate on the bond. That's what will actually be paid out. So we're going to have to put in the 0.1 or 10%. I'm going to go to the Home tab. We're going to go to the Numbers group. I'm going to add decimals or just go to the percent there. Then we're going to go to the Home tab, Font, underline that. And if we multiply that out, we've got the 790,000 times the 10%, and then we get the 79,000. Now, of course, the thing to remember every time we talk about interest rates, the rate means interest for a year. That's just what we mean whenever we say interest rate. So interest rate, unless otherwise specified, means for a year. We're only paying interest for 6 months or half a year. So we could, say it's 6 over 12, 1/2, or just divide by 2 for half the year. And we're just going to say that equals the 79,000 divided by 2. Therefore, we will have semi-annual interest payments every 6 months, $39,005. Next one says a company issued 9% 15-year bonds with a par value of $460,000 that pay interest semi-annually. The current market rate, 9%. Well, that's coincidence. The market rate equals the bond rate. Doesn't happen too often. The journal entry to record each semi-annual interest payment is what? Alright, so we're going to have to calculate the interest payment once again and then figure out what the journal entry would be in order to record that interest payment. So these are going to be semi-annual bonds. We're going to say 460,000. We're going to multiply that times the interest rate. If we move the decimal 2 places over to the left, it's 0.09. And then I'm going to go back on that. I'm going to go to the Home tab, Numbers group. Going to add decimals, 0.09, or just make it a percent. Home tab, Font, underline it. Then we're going to do the calculation here. We got the 460,000 times the 9%. And just so you know, we're taking the 9% here. That is the bond rate, not the market rate. So although they're the same number, we're using the bond rate 9%, not the market rate 9%. Those will not be the same very often. So that would be interest for a year. So remember that 9% means interest for a year. We then need to see the fact that these are semi-annual. And that means they're paid every 6 months or half a year. So we could do it this way. Semi-annual means we're paying for 6 months over 12 months. Or, of course, if we were to go to the Home tab, Numbers, add decimals, 0.5 here. So it's going to be half a year, 0.5 a year, 1/2 of the year. 41.4 times the 0.5. There we have it. Now, if we have the journal entry then, the journal entry is cash affected. Yeah, cash is going out. We actually have to pay this interest. We have to pay the cash for the 20,009. And then there's going to be a debit. What's the debit going to be? It's going to be some type of interest expense. It might be bond interest expense, but in some way there should be interest expense on the income statement, reducing net income. Next one says that on January 1st, companies issue 7.5% 10-year bonds with a par value of $3,600,000. The bonds pay interest semi-annually. The market rate of interest is 8.5%. The bond selling price was $3,355,377. The bond issuance should be recorded as what? So we need the journal entry for issuing the bond. What does issuing the bond mean? It's kind of like a loan. We're issuing the bond, we're getting money, and we're going to have kind of like a loan that we'll have to pay back at the end at a certain interest rate. What's the difference between a bond and a note? If it was a note, the thing that we usually change would be the interest rate. We would say, okay, you want this much money, we will mess with the interest rate in order to get to the market rate, and that's how we will negotiate the terms. But in a bond, we're going to say that the bond interest rate has already been set. It's like you can think of it as set in stone. Can't change it. Already there. And if it does not match the market rate, then we're going to have to change something else other than the bond rate. So in this case, what can we change? We can change the issuance price. So we've got a 7.5 rate on our bond, and the market rate is 8.5%. Therefore, we can't just get the face amount of our bond. We can't just get the 3,600,000 because someone can go somewhere else and get 8.5% on it. So we can't change the rate. What can we do? We could say, okay, we'll give you the bond and you only have to give us something less than the face amount, being the 3.355. How would we figure that out? That's for a different time because this problem just gave us that calculation. So if we think about this, we're going to say, well, is cash affected? Yes, we've got cash, and they didn't tell us to figure it out. We know the cash we got. We got the 3,355,377, so 3,355,377, and then we had to give the bond being bond payable. We're not the investor of the bond in this case. We are issuing the bond. It's a liability, so we have a bond payable, and that's going to be for the face amount, the entire face amount, 360,000. That's what we're going to have to pay back, and then there's going to be a debit. And that's going to be the difference. So this number minus this number means I'm going to do the negative sum this way. And it's going to be this minus this. And that gives us the plug so that this plus this equals that here. And obviously, if you want to figure that out mathematically, you would just say the 360,000 minus 3,355,377. That's this number. That's going to have to be a discount. And the trick on these is to know whether it's a discount or a premium. How do you know that this is going to be a discount? Well, because I usually think about it as if we're the purchaser of the bond. If the sticker price on the bond on the face amount says 360,000 and we're only paying 3,355, we as the purchaser got a discount. So that's how I would think about the discount. If on the other hand, it was going the other way, that we paid more, why would that happen? Because these market rates would be flipped. And then we would be paying more, we'd be paying a premium. Now, when you see this, I'm going to go ahead and say this equals this in the journal entry. If we see it in a book problem, it's not going to be lined up in this way because we want the debits on top. I would build the journal entry in whatever fashion that makes you be able to see it best. And then, of course, when you see it in the problem, it's going to be lined up probably like this. Or they might only ask you for half of it. They might just say, hey, what's the credit going to be to bond discount? What's the discount going to be? Is it going to be a debit or a credit? And I would build the entire journal entry even if they only ask you for a piece of it.